Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 116 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So, good morning, Matt.
Morning, Mark. A little fall weather outside.
Yeah, it got cold quick. It was like 75, then went to like 55 yesterday, and here we are sitting at like 50 right now.
Yeah, I woke up, it was 48.
Yeah. So, big weekend this week, Ryder Cup at Whistling Straits in Wisconsin. So I had the pleasure of playing there last year. So it's going to be fun for me to watch these pros tear it up and just think about how I got destroyed when I went and played it about a year ago today.
I would imagine. We don't even want to talk about how bad I would be there. But
so, yeah. So that's...
it gives you much more respect. For what these guys pull off
the
every
professional
Sunday.
athletes.
I say the last day, but you see.
Yeah, and I can go on a rant of people that say golfers aren't professional athletes, but I'm not going to go there today.
I differ.
As always, we'll start with a recap of the performance of the major indexes that we track, and these numbers are as of the market close on September 22nd, and this data is from Koifin. S&P 500 index is down 2.8% for the month of September, but up 17% still on the year. The Dow down 3.1% on the month and up 11.9% on the year. The NASDAQ Composite Index down 3.7% for the month and up 14.4% for the year. The IWM ETF that tracks the Russell 2000 Index down 2.2% for the month and up 12.7% for the year. Vanguard International ETF ex United States down 1.8% for the month and up 7.55% for the year. Three-month T-bill yield is currently at 0.03%. The 2-year Treasury yield sitting at 0.25%, and the 10-year Treasury yield at 1.34%. Kind of big in terms of news and headlines from the past week, Matt, starting off with House Democrats releasing their proposed tax bill last week that has some large implications on retirement planning, tax planning, and estate planning. And I won't get into all of this right now, but for the financial planning topic of the week is a little teaser. That's what we're going to be talking about, is these potential changes.
Be great.
Most recent Federal Reserve Board announcement on monetary policy came out yesterday on the 22nd at 2 o'clock. This is just a snippet from the Wall Street Journal. Central bank officials prepare to reverse pandemic stimulus programs as soon as November. New projections showed half of 18 officials expect to raise interest rates by the end of 2022. And in my opinion, Matt, this is a positive thing because the Fed views things as the economy is strong enough to handle higher interest rates and less stimulus and money printing. However, this is a change of course from their initial thoughts, that interest rates were going to stay where they were until at least 2023. My opinion, I think it's kind of bullish long term, but what are your thoughts?
My base case hasn't really changed. I still think they start to move right after the midterm elections next fall. That's my base case. I think that kind of lines up with this. I agree with you. I think the economy can handle it. I really do. And so in my opinion, I think this is right along with my thought process base case. And I think it's, relatively speaking, a non-event for the market right now.
Yeah, agreed.
It's like, this is past us. The Fed's not going to meet for another 6 weeks.
Yeah, and markets actually rallied. Like if you saw just a daily, like a 30-minute chart on the S&P 500 after that 2 o'clock Fed announcement, we ramped up and we eventually gave those back. But
I think it's a good thing. I think that's a good thing.
And then third, obviously, everyone is wondering about the market volatility over the past week. And a big reason for this, I think, is concerns about China's Evergrande. It's the world's most indebted property developer with $300 billion in debt. is reportedly on the brink of defaulting on his debt. And this is understanding, I guess, which is triggering worries about systemic financial risk for China that could reverberate beyond China because, for example, there are U.S. financial institutions that hold debt of this Evergrande. So can you just tell people like what's going on here?
Yeah. So listeners, over in China, this big property developer has overextended themselves. They have borrowed money to manufacture and build properties. And right now they're having issues paying all their obligations. And so people are concerned that they're going to default on this debt, and it could have a domino cascading effect across certain sections of the financial system. And so that's the reason.
And just 10 seconds, can you explain what defaulting on debt means for people that don't know what that means?
So the basic term there, Mark, is they are not able to pay their obligations. They don't have enough money to pay their obligations.
They can't pay the loan back.
Cannot pay the loan back, and then obviously would trigger an event where obviously they would default, and people are concerned, again, it cascades through the system, that people might have bought other assets with that debt being the collateral is the concern. And so ultimately, in my opinion, I don't think this is as big of an issue for the market because a majority of this debt is domiciled in China. I saw a stat that only roughly less than 20% of that debt is owned in an international stage, which makes me think that from a social economic standpoint, I do think China is going to try to be involved with this. My 2 cents. I could be wrong.
Yeah, well, I just saw a Wall Street Journal notification this morning that said that they're not going to bail them out.
Interesting.
So obviously that could change, in 30 minutes.
Absolutely.
But that's the first word out of it. And I don't know if that's just China playing hardball, but that's what they said initially this morning.
That could be part of their capitalism crackdown. But ultimately, I don't think that this is as widely owned on the international stage as the market is trying to have an analogy to a Lehman Brothers moment going back to like 07, 08 and the great financial crisis. I don't think this is on that same level, my opinion, and I think the market's overreacting.
Yeah, and I think it's heightened because we have been in this low volatility environment for the whole year. And suddenly when you get a spike in volatility, it feels a lot worse than it actually is, right?
That's right. And so, we haven't had a correction in a while. Each time we have these corrections, when you're in the middle of it, it feels like this could perpetuate and continue on for some time. Is it a possibility? Of course. I just don't think in this case, the reason for the sell-off is going to hang around and affect the earnings of XYZ company.
Yeah. And again, the market's forward looking. And if this, was going to be a concern because this just hit the mainstream media in the past week and a half. And if this was going to be a problem, I think we would have seen a lot more volatility leading up to the month of September, and we haven't. So, again, it's one of those things where it's like very widely talked about, probably not going to be the thing that brings the markets down.
Well, the last thing I'll say, and I agree with everything you said, Mark, people are waiting for pullbacks to have fresh capital on the sidelines. Opportunity, are people going to take advantage of it?
Right.
Or if I'm right and the market's higher, say by the end of October, people are going to look back and say, "Oh, I missed my opportunity on that." But I definitely think people who've been waiting for a pullback, here you go.
Yeah. See if they bite.
That's right.
The first thing I have from tweets, articles, and research from the week is just kind of a follow-up to your points made last week about leveraged ETFs. So if listeners want to kind of listen about what we talked about with leveraged ETFs, go check out episode number 115. So briefly, again, just to kind of describe what ETFs are in Bespoke's words, rather than mirroring the performance of an index or a specific asset, leveraged ETFs seek to provide a multiple of that performance through the use of derivatives, for example, options contracts, but I'm not going to get into that today. So if you want to learn about what options are, then look that up. and debt, usually double or triple that of the underlying asset. These ETFs are meant to track a multiple of daily performance. So, for example, 2 times daily performance or 3 times daily performance. So, raw numbers, S&P 500's up 2% on the day. The 2 times leveraged S&P 500 index is up 4% on the day. But this also means that long-term performance tends to not equal 2 or 3 times that of the unleveraged instrument. The companies offering these leveraged ETF products do explain that they track daily performance only. But even still, many investors overlook the fact and choose to own them longer term. And again, see last week's episode if you want to hear a discussion on that further. So in this article, the charts show the hypothetical performance of $100 invested in a handful of leveraged ETFs, as well as a more vanilla unleveraged alternative at the start of the year through September 13th. We would also note that it's purely price returns before any payouts and or expenses. Starting with a look at long-term treasuries, $100 invested at the start of the year into the iShares 20-plus year bond ETF, ticker symbol is TLT, would be slightly in the red headed into the final quarter of the year. Meanwhile, someone betting on the Direxion Daily 20-plus year Treasury 3 times bull ETF, meaning they expect treasuries to increase,
higher, yep,
would see their $100 fall to $83.24 today. At the low on March 18th, that $100 would have fallen as low as $60. That's right, a 40% decline for something tracking what is supposed to be a relatively risk-free asset. As for some other assets, the energy sector ETF, ticker symbol XLE, and financial sector ETF, ticker symbol XLF, have been 2 of the best performing sectors this year. As such, $100 invested into XLE and XLF would have grown to $129.79 and $128.69 respectively. For energy, the 2 times bullish ETF, ticker symbol ERX, would have seen that same $100 turn into a little more than $160. And opposite side of that trade, ERY, which would be the 2 times bearish ETF, would see the $100 more than cut in half. Same goes for the 3 times bet for financials. The Direxion Daily Financial Bull 3 times shares ETF, ticker symbol FAS, has nearly doubled year to date in 2021, whereas the inverse bearish ETF, ticker symbol FAZ, would have turned a buck into less than cents. So I think it's just important to realize this is just more of an educational thing, I think, because I think people think that if the S&P 500 is up 20% for the year, the 2 times bull ETF is up 40% for the year. And that's not the case because these things track daily performance.
That's right.
Right?
That's right.
So when, you're up 2% in a day, then you're up 4% in a day in the 2 times leverage ETF. But if you're down 2% the next day, you're down 4%. So you have to take that stuff into account. So I just wanted to provide this because, if you're picking the right sectors, you could have some winners, but also the losers are multiplied as well.
I think this is a great warning because I think on the surface, you're right. If it's up 2 times year to date, I should be up double the index. Mm-hmm. And it doesn't work that way. The math doesn't work that way. And in addition, these products are a lot more volatile and leveraged than the average retail investor, I think, should be involved with.
Yeah, agreed.
I think it's a great warning, though, because we got to remind people, I think when you see returns and you want to chase them and you want to get this leverage, it seems appealing. There's more underneath the surface that you really need to look into. And you're alluding to a couple of those. So retail investors, please tread carefully on this one.
It's appealing until it's not.
That's right.
Right?
That's right.
The next thing I had was a tweet from Lizanne Saunders, who's the chief investment strategist at Charles Schwab. So Lizanne, tweeted this last week. No correction for the S&P 500 this year, but yes in the following areas. The NASDAQ corrected a little more than 10% in March. The S&P 500 Energy Index corrected multiple times throughout the year and is currently more than 10% off the highs. The S&P 500 Materials Index corrected more than 10% in July, and the S&P Consumer Discretionary Index corrected more than 10% in March.
Yep.
So the thing that I want to go over here, Matt, is we've been in this like silent correction for the past 6 months, in my opinion.
Yes.
And just because the S&P 500 index hasn't corrected doesn't mean any other areas of the market have. So, another example of this is I think the NASDAQ composite, like 34 or like 36% of the constituents in the NASDAQ composite index are like 20 or 30% off their highs.
Correct.
So just because, we haven't seen a large 10% pullback in the S&P 500 does not mean that we haven't seen it in any other areas of the market. And, I think people can be fooled by that because people are like, well, the markets can't keep marching higher without at least a 10% correction in the S&P 500. And I could make the argument that it can.
And I think this is a great point because listeners, there are a lot of stocks, as Mark said, that are nowhere near their highs. And with this consolidation, another good way of saying it, it makes the market, its next move, healthier, in my opinion. Because I think the perception, Mark, is the market's been going up, going up, going up, going up, and it can't keep doing it. But as you're saying, if you take an X-ray view of a lot of these names, they're nowhere near their 52-week high. And I could even argue we could take a lot of names in the top 10 or 20 of the S&P 500 by market cap, and a lot of those are nowhere near their 52-week high.
Right. So I just, want to throw that out there that they're, under the surface, we have been in a correctionary period in some areas in the market.
Absolutely. It's a great point. And remember, not all stocks are created equal.
Yeah.
And I think just trying to label what the S&P is doing or the NASDAQ's doing is not fair when you start looking at individual names.
Yeah, agreed.
And I do think there's been a stealth consolidation over the past many quarters that could set up a healthy next leg higher.
Yeah, and again, and maybe this is just me because, we're in this industry, but, it's still baffling to me that like industry pundits are like, so concerned because, Apple and Amazon have gone nowhere for a year. But companies that rocketed off of the low in March and February of 2020, when you have returns like that, when companies are doubling and tripling, they need a break.
They need to consolidate.
They can't go higher forever.
That's right.
So again, my opinion, not concerned about that.
No, I think it's great. I'm glad you pointed this out by Liz Ann.
The last thing I have is just like kind of a fun thing that I read in the Wall Street Journal titled "Thanksgiving Turkey Shopping Has Already Started for Supermarkets."
Here we go.
So supermarkets started getting their turkey orders in February for Thanksgiving.
February.
Matt. Yeah. So, just again, it summarizes supply chain constraints for these, mega grocery stores that they're trying to make sure that their shelves are stocked for the holidays. And again, just a reminder, that holiday shopping could be very different this year. So get your stuff as early as possible.
You've heard it here multiple times over the last couple of months, listeners.
Yep.
Shop early.
Yep. I'll turn it over to you.
I love that you did this, the turkey item, because I do think you're going to see larger gatherings. I do think it's going to be the case, which means that most likely the average pound of the bird that's sold is going to be higher than the previous year. And I would expect, the prices when you go are going to be a lot higher than they were a couple years ago.
Yeah, absolutely.
There's going to be some expensive birds.
Yep.
Okay, listeners, my first item I want to cover today is in regards to cord cutting. Where does that stand? I haven't talked about this topic before.
No.
Okay? So before we proceed, Mark, define cord cutting.
Yeah, so that's pretty much just people transitioning from like traditional cable subscriptions to streaming services, or what we call over the top, which is, companies like Disney Plus, DirecTV Now, YouTube TV, that these streaming services are all over Wi-Fi and it's no longer traditional cable. And the thinking there is it's a lot cheaper for the consumer, right? Other avenues are, ESPN Plus. So, there's a ton of them out there now, but, just getting away from the traditional cable companies of the world.
Exactly. And more maybe of an a la carte type of setup.
Correct.
Right? Here's what I found really interesting, okay? There was a tweet by OMG Capital. Don't you love that one?
Yeah, the Twitter handles always get me, man.
And it shows a chart, and underneath it, the source of this one is Ampere. Did I say that correct? Ampere?
Your guess is as good as mine. Let's go with it.
Ampere analysis. Yep. But here's what it shows. It shows pay TV subscriptions as a percentage of households. And in the U.S., if you go back to 2010, over 80% of Americans, according to this data, had quote-unquote cable TV. Mm-hmm. Now, if you fast forward from 2010 to now, that figure is below 60%. Mm-hmm. And it's clearly in a downtrend.
Right.
Okay?
Very clear.
So,
and again, you can go to Jessup Wealth Management on Facebook or LinkedIn, or at Jessup Wealth on Twitter, and see this exact chart that Matt's talking about.
And it's just interesting to see that trend, because as investors, you're looking for longer term trends that play out. This one's very clear that
in the U.S.,
U.S., that the market share of cable companies continues to go down. Mm-hmm. Here's the interesting thing. This chart also shows France, Germany, Great Britain, Spain, and Italy. They have not seen much degradation in cable, which I found interesting. That cord cutting, quote unquote, has really taken hold. It's a clear trend here in the U.S., but not in Europe. And I found it interesting, Mark.
Yeah, it's interesting. And I mean, you can make a strong argument that France is actually in an uptrend of, pay TV subscriptions.
I just found it really interesting.
Yeah.
All right. Next item that caught my eye. An interesting view on housing prices.
This is the other thing I want to just throw out there, too. I was talking with Nick about this the other day.
Nick's our Director of Research and Trading.
Yeah. So I had the DirecTV. When DirecTV came out with their streaming service, I jumped on it.
Yep.
And that's Matt's alarm going off for those who
I
are wondering.
have to set alarms for various things. I apologize, listeners.
So I joined with them as soon as they came out, and then, their DirecTV Live, I think it was called, or something like that, went to or it was DirecTV Now, and then it was AT&T TV Now, because they're under the same family company, and now it's DirecTV Stream. So I'm on like the third iteration of the streaming service. But I was talking to Nick that at least 2 or 3 times a year I'm looking at like my bill, and it keeps increasing.
Oh, we're doing the reverse again.
Right. So I'm like,
we cord cut to save money.
Right. At what point are we going to get back to the fact where these streaming services are just as expensive as these cable companies or traditional pay TV subscriptions?
Here's what I'd argue the difference is. You don't have a captive audience like cable has had for many, many years. It's the ease of switching and going from a DirecTV to a Hulu or to a YouTube TV is drastically easier. And in my opinion, I think that will slow those slow phantom price raises that cable has done over the years.
Yeah, and I think eventually, you've seen some of the a la carte stuff and like bundling that stuff together, but we still haven't gotten to the point where it's true that you select what channels you want. So if I only watch 10 channels, if I only watch all the ESPNs, I want the Discovery Channel and the Cooking Channel.
That's it.
NBC, and that's it. There's not really an option to do that.
Or I would love the ability to sit there and say, well, tonight I'm going to watch Bloomberg for a little bit. I pay for what I watch.
Right.
It's almost like going back to the old school dial-up AOL. They charged you by the minute.
Right.
If they went to some sort of format like that and, I see that this game is on and it's on the NFL Network, I'll pay a little extra by the minute to watch that game.
Right.
I would do that.
Yeah, I would too. So just interesting there. Sorry.
No worries. This is why people listen to us. I love it.
Go off the rails
Go
a
off
little
the
bit.
rails. So, all right, my next item for listeners, Mark, is an interesting view on housing prices from Leader Capital. And this is a research note from September 7th. And I'm going to give the quote first. Quote, "We think the inflation trade is short-lived and commodities will recede, in particular lumber and building supplies, causing another semi-2008 housing decline. In addition, the heavy buying of single-family homes by institutions and individual investors will exacerbate the decline. Replacement costs are the primary drivers of home prices, not mortgage rates," end quote. Now, Mark, I find the replacement cost thesis interesting to be part of the rise in real estate. My opinion is that it's not as much of a large part of the rise in prices as Leader is indicating, but I do think there's a piece of the puzzle that has not been really discussed up to this point. And Mark, what are your thoughts about this?
I think what's not talked about enough is when you modernize homes, prices go up. When you can do more in your home than you did 20 years ago, prices are going up, right? Homes are more efficient, prices go up. There's more technology in homes today, prices go up. So it's not all having to do with mortgages and interest rates like most people think.
Yeah.
And I could be the first one because my home that I live in now was built in 53, I believe. And I'm making home improvements and upgrades to modernize it and have a low level of maintenance.
Yep.
And that's going to increase the value of my home over time. So I think it's just one of those things, as, for example, the iPhone, when it came out, prices increased because, yes, $100 today is not worth, $100 20 years ago is not worth $100 today. But there's been upgrades in the iPhone, right? So the more upgrades there are, the more user-friendly it is, the higher the cost, right? So you got to think of it in those terms, I think, too.
I thought it was an interesting kind of viewpoint that is just not really discussed right now. Mm-hmm. So I wanted to point that out to listeners. All right, I got one more for you. This is a blog post by Charlie of Compound Advisors on September 16th. We reference Charlie's stuff a lot from Compound Advisors. So this was the title of his blog post. Expectations are everything. And this is from September 16th. Okay. I'll read this because I found it fun and I thought listeners would love this. He starts off, "This is a story about expectations. But first, I want to read to you about Company A and Company B. Company A has revenues of $66.8 billion over the last year and had net income of over $7 billion. It was founded in 1912 and has over 100,000 employees. Company B, Mark, has revenue of $851 million over the last year and has a net loss of $761 million. It was founded in 2012, Mark, and only has 2,500 employees. Company A, Company B. Question, which company has a higher market cap?" Ready for this? Surely you're thinking it must be Company A, which was started 100 years earlier and has fundamentals that are far superior. And in the world of academia, that would be correct. Turns out, this is not a hypothetical. In the real world, Company B that he's talking about is a stock called Snowflake. Actually has a market cap that is $2 billion higher than Company A, which is Lockheed Martin. So I want to point this out to listeners because how could this be? Academia world says it shouldn't be that way, right? Mm-hmm. Charlie sits there and says investors are valuing Snowflake at over 98 times sales versus 1.4 times sales for Lockheed Martin. Why would they do such a thing, Mark? Because Snowflake's growth rate in their most recent quarter is 104% year over year, far exceeding Lockheed's similar stat of just 5% growth year over year. And investors are betting that this phenomenal growth will continue for some time. Will they be right? Only time will tell. And he finishes with this. As Morgan Housel has said, quote, every valuation and forecast is a number from today multiplied by a story about tomorrow, end quote. The story of Snowflake's future is so good that investors are willing to pay an astronomical multiple today, but nothing's permanent. All stories change over time. And as the story of Snowflake changes, so will investor expectations, and in turn prices. Expectations are everything in the markets.
Mm-hmm. Yeah, so two things come to mind. Number one is this is a perfect example of how what you're taught in college about economics and how stocks work is garbage. It just doesn't work in the real world.
Well, I'm just going to throw it out there. This is why professors at universities don't manage money. I don't mean that to be rude, but that's why they don't.
And number two is, I love because we talked about this before. I think we probably talked about that exact piece from Morgan Housel, is that everyone loves a story. Pick like Tesla, for example, right? Back when it had its rampant rise, it's because Elon Musk could tell an amazing story about what Tesla is going to be, and investors bought into that.
And
it doesn't matter if they were making money or not.
He has a vision, and he conveyed that vision.
No, it doesn't matter if they're making money or not. And there's been several examples of this over time. Netflix was the same way, but people saw the vision.
Yeah, going from mailing you a DVD and returning it to streaming.
Right.
That was a big leap.
Yeah, and at one point, I'm sure everyone was like, Blockbuster isn't going anywhere. Look what happened.
There's one left in Alaska.
Yeah. So it's just, that's why I'm just never surprised on what goes on in the markets, because it never works out how it's quote unquote supposed to, looking back on what people learn in college or read in, academic books.
I absolutely agree. I thought it was great to point out we are not advocating for or against any of the individual names we mentioned. I want to be very specific about that. Rather, I think that Charlie provided a good example between the two. And we just got to remember that sometimes you look at the quote unquote fundamentals of two different names and it might not make sense. There's other things going on behind the scenes as to why investors have paid up for one company compared to another.
Yeah, exactly. And sometimes it turns out bad. You have a storyteller like the guy from WeWork, and, there was shady stuff going on there and it didn't work out, but the guy could tell a story and people bought into it, right? Yeah. The same with, what was the electric car company? Nikola.
Yes.
That they had some accounting fraud or whatever, but again, had a CEO that could tell the story. Investors bought into it.
Yep. I think they ramped the prototype down a hill because it actually didn't work.
Yeah. So it's just, it's all about storytelling, in my opinion.
I thought it was a great example, and I think it just provides perspective to our listeners as to why maybe one company is valued more in the marketplace than another. It goes beyond, my earnings today are X. There's a lot of factors, and future expectations is one of those factors.
Yeah.
Back to you, my friend.
So switching gears, we're going to talk about the bill proposed by House Democrats last week that has significant planning consequences, I think, going forward if it's passed the way it is. And again, I just want to be very clear that, this could still get changed. This is not written in stone. It's going to get passed in the Senate because it's pretty much going to have to be a party line vote, I think, to get passed in the Senate. So this could be something that drags on for a very, very long time before anything gets passed, and there could be several changes to this before this becomes law. So
I'll just throw this out there before you begin. The feeling I'm getting by kind of the news stream right now is a lot of politicians are afraid to take stances with the midterms around the corner.
Yeah.
And I think the Biden administration, I heard, is meeting with a lot of the more major players on their side of the aisle in an attempt to get them to move on some of this legislation. And I think that a lot of politicians are concerned about the midterms next year.
Yeah. So again, we're not going to go over, all of this because we could sit here for 5 hours and discuss it, but just a couple of things that I think people would be interested in.
Cover the highlights.
The first aspect of this is taxing the rich, right? So for those whose income is above $400,000, which is in the top 2% of households. So Section 138201 would create a new top tax bracket of 39.6%, and that's up from the top tax bracket of 37% right now. Also, the new 32% bracket would be $164,000 to $200,000 of income for single people, and $330,000 to $400,000 for married filing joint. The current 32% bracket is $164,000 to $210,000 and $330,000 to $419,000 respectively for single and married. So taxes are getting raised on that group of people that fall in that income bracket. Also, a massive change is the 35% bracket goes to $200,000 of income to $400,000 of income for those who are single, and $400,000 to $450,000 for those who are married filing joint. Again, the current 35% bracket for those who are single are $210,000 to $523,000, and those who are married, $419,000 to $628,000. So taxes are going up significantly on that group of individuals.
Yeah, and I don't know if you can go back and remember the campaign promise, but I thought the campaign promise was no taxes were going to go up for anyone making less than $400,000, and that's not what I'm hearing.
And that's the key, is that everyone is attacking it for that, but we also have to remember this is the House Democrats. This is not the Biden proposal, right? So, but again, if it does get passed, then yeah, people can question that all day long.
The other point I want to make for listeners is we do have listeners that are probably on the East or West Coast, and 400,000 in the Midwest is not 400,000 on the coast.
Right.
And, I've seen a lot of examples of a dual income household that have kids in private school in very expensive parts of the U.S. And, do they live a very comfortable lifestyle? They do, but it's not like they're rolling in the dough.
Right.
And when you see these tax increases for those people in those parts of the nation, it's not gonna be easy.
Yeah. Yeah. And that's something that I've always thought about is like, how do you adjust for cost of living in different areas of the country?
From a taxation standpoint,
yeah,
it's impossible.
Yeah.
Because I think that's an advantage of you and me living in Dayton, Ohio.
Right.
I love living here.
Mm-hmm.
Our cost of living compared to larger cities is a lot less.
Mm-hmm.
And, the dollar, you can stretch it farther here.
Right. Right. Moving on to capital gains, this bill proposes a increase in the top capital gains rate to 25%, and currently the top capital gains rate is 20%, which is much more than what was proposed earlier by the Biden administration, which would be increase it to the top tax rate of 39.6%.
Now, before you continue, let's explain to listeners. I'll start over. So let's explain to listeners, Mark, what is a capital gain?
So a capital gain is that if, let's say, the best way is to provide an example. If you buy stock X for $100 and sell it for $120, you have a $20 capital gain. And if you hold that for longer than 12 months, then you get a preferential capital gains tax rate, which is lower than your ordinary income. So your capital gains rate is based on where your ordinary income falls. And the capital gains rate is always for right now, is lower than ordinary income. So it makes sense for people to hold an investment for longer than a year.
And we're not talking just stocks.
This
could be real estate.
Real estate, investment properties.
This could be baseball cards. This could be any sort
gold watch.
Any sort of investment where you buy it at X amount, it goes up. You hold it for at least a year and a day, you get this preferential tax treatment.
Right. But if you buy stock X for 100 and sell it for 120 and you only hold it for 8 months, that $20 gain on that is taxed at your ordinary income tax rate.
Whatever it gets added to the top of the pile at the end of the year based upon your income.
Right.
Whatever you fall into, you fall into.
So it's more favorable at this point to hold something for at least 12 months because there is a favorable tax rate on it. Okay.
Thank you.
So the top capital gains bracket would start at $400,000 for single filers and $450,000 for joint filers, which is not good for, the affluent taxpayer who has capital gains. And it's really, not good for people that are married filing joint, because it's only $50,000 different income limit that's above filing single. So a lot of the things that you're going to hear in this bill, I think makes people consider and get with their tax professionals and say, hey, even if we're married, does it make sense to file separately?
Yeah, absolutely. Especially, back in the day, it was hard to make a Roth IRA contribution, and you couldn't file separately. They wouldn't let you.
Right.
I mean, some of these things are going away where it might make sense for you to do married filing singly.
Mm-hmm.
Yeah.
So the current top capital gains rate is 20% for single filers with income greater than $446,000 and married filers with income above $502 roughly $1,000. So again, big changes there. And this is the interesting thing. Under this proposal, if you sold something today, and this came out on September 13th of this year, or before today, then you lock in a top rate of 20% on your gain. Sell something tomorrow, i.e. September 14th of 2021, or in the future, and your rate will be as high as the 25%.
They don't want people gaming the system.
Except in the situation where you entered into a binding contract before the end of the day that is not materially modified. So this would be retroactively going back.
They don't want people all of a sudden, I'm going to harvest these gains at 20%, not 25.
Correct.
Yeah.
Again, it's really
retroactive.
It's really, and again, and I'm not trying to, make excuse for financial professionals in our industry, but it's hard to try to plan around this stuff because you don't know if these provisions are going to be in there. So if you sell and recognize a lower capital gain now and still have a pretty big tax bill for the year, and then this gets taken out of this bill, it's like, okay, you sold that and created a tax consequence for nothing, right? So it takes a lot of thought to figure out what to do here, right?
That's right.
Section 138203 puts a limit on the max 199A deduction, which is also known as the qualified business income deduction. So this affects sole proprietors, LLCs, S-corps, and it allows people with small business income to deduct 20% of their income on their taxes, which is huge. And instead of the phase out goes away, and anyone making more than $500,000 of income for joint filers or $400,000 for single filers, those are the caps on the deduction. So anything above that, you no longer get the 20% deduction. So that's tough for small business owners too.
That's not going to encourage job gains.
No, it's not. Section 138311 talks about the elimination of some planning strategies. So this section eliminates all Roth conversions for high income taxpayers.
And they're just taking shotgun blast at this tax code, aren't they?
Yeah. And in the new highest ordinary income bracket, which is 400,000 plus. And this change would go into effect on January 1st of 2022. After-tax amounts in retirement accounts will also no longer be available for conversion to Roth accounts.
So they're getting rid of the backdoor Roth.
Correct. For people that make more than $400,000. So if listeners, aren't aware right now, I'm not going to get too into it, but there are income limits for you to be able to contribute to a Roth IRA. And if you're above that income limit, you can do what's called a Roth conversion, is you can make a non-deductible contribution to a traditional IRA and convert it to a Roth IRA. And you can do the same thing with your 401k and convert it to a Roth IRA. However, if you're making more than $400,000, Roth conversions go away.
They'll eliminate that ability.
And again, this should be a pretty big topic of discussion, in my opinion, because in some instances, some people only have a couple months to convert money to their Roths, and sometimes people have been making non-deductible contributions to their 401k and IRA, and if this goes into law, they got to do that if they're, of course, above the income threshold.
Yeah.
Right. It also prevents any new contributions being made to any IRA and Roth IRA of a taxpayer who meets the following two requirements. You have AGI above $400,000 if you're single, or $450,000 if you're joint, and has total retirement accounts valued at more than $10 million. So, I mean, okay, I guess people are looking at this and saying, okay, if people have more than 10 million in IRAs, then they should be fine. Okay, that's fine. The thing that doesn't make sense to me about this, Matt, is if they're really targeting the quote unquote rich or 1%, this does not include 401ks, SEP IRAs, pension plans, which all have much higher contribution limits.
Yeah, it's true.
That doesn't make any sense to me.
No.
But, not the one making the rules. Section 138302 would create new required minimum distributions for individuals with high retirement account balances, regardless of their age, effective for 2022. And again, if you fall into this category, the 10% penalty would not be enforced for early withdrawals for those who are going to have RMDs who are under 59 and a half.
Well, isn't that kind?
Very kind. So this is kind of crazy. We're talking about a lot of money here. And again, people can look at this and be like, this is going to be fine for people that have this type of money, which, I understand that viewpoint, but it does get kind of crazy here. Anyone with income in excess of the thresholds discussed earlier. So if you're single and you have more than 400,000 of income, or joint have more than 450,000 of income, if you have 10 million, between 10 million and 20 million in total retirement accounts, you're now required to distribute 50% of that excess over $10 million. So
50?
Yeah. So round numbers, you have 15 million in retirement accounts. You're required to distribute $2.5 million in an RMD.
And if it's in a traditional IRA, which would be a taxable income,
which is crazy. On top of that, if your income is over the threshold and your total retirement account balances are north of 20 million, then 100% of the excess must be distributed as an RMD.
100?
100. And you still have to account for the 50% that falls in the 10 to $20 million range. So if you, if you fall in any of these categories, you have to take the money from Roth IRAs first.
I'm laughing, listeners, because this is just comical to me.
So for example, if you have 25 million in retirement accounts, then you have to take a $5 million RMD because that's the excess over 20 million. And then you would have to take another 5 million RMD because that's 50% of the excess left between 10 million and 20 million. So that's a $10 million RMD that is potentially totally taxable income for that year. And again, I don't know how I feel about it, because I understand what these legislators are trying to get at. But maybe there's just no fair way to do this, because, you're harming the next generation, right? And you don't know what situation the next generation is going to be in. Maybe they're not going to have as good a situation as their parents or grandparents, and maybe they need to fall back on that money. So it's just kind of hard to wrap your head around the best way to go about this. But I'll tell you what, this is going to have significant impacts on people's estate planning strategies, especially for, the top 5% of people in this country.
Yeah. And again, I want to reiterate what you just said. Everything you've mentioned is not just hitting the 1%.
Mm-mm.
It's not.
No, it's not. An example of this is, maybe you have a kid or a grandkid of a wealthy family that this affects, and maybe they're not taking a traditional job because they're going to do mission work. They're making it their life goal to do mission work where they're not really going to have an income, but they would fall back on their family's, assets. It's just hard to make. And again, I'm sure that's few and far between, and people can make the argument that most times that's not the scenario. But all I'm saying is either way you slice it, there's going to be no fair way to create this tax code.
I absolutely agree with that. And I think that it would be naive to think that this is not going to have an economic impact, and it's, in my opinion, not going to be positive.
Yeah.
To
Agreed.
what degree could be debated. Mm-hmm. But I think the purpose of this is, call it for what you want, it's more income equality. Mm-hmm. And to raise money for some social spending, and that's what it's about. And you could debate that. But ultimately, this is going to be negative for small business owners who create a ton of jobs in America. Mm-hmm. And if you're really trying to cultivate that area, this is not something that's going to help that.
Yeah.
My 2 cents.
Just a couple other things to button this conversation up. The top corporate tax rate is going to go from 21% to 26.5%. The international tax rate, the minimum tax would raise to 16.6% from 10.5%, and companies would now only be able to exclude 5% of their foreign tangible assets, which is a decrease from the current 10%. The other thing I'm going to throw out there is they're looking at potentially changing the positive tax efficiencies associated with exchange traded funds. So again, this might be something that we get into in another episode, but just very quickly, if you invest in a mutual funds, when they buy and sell stocks, they're required to pass those gains or distributions on to investors, and investors pay taxes on that. ETFs are set up where the redemptions, i.e. the buying and selling of stocks to track an index, for example, they are not distributed to shareholders. So ETFs are a lot more tax efficient in taxable investment accounts than mutual funds because you don't have any distributions to pay taxes on. And currently in the proposal, they're getting rid of that. And I want to make the very strong argument that affects everyone everyone except the rich, right? Mm-hmm. Because the average retail investor is utilizing, some sort of ETF for their investments.
I think there's a lot more exposure.
So that's something that I really hope that our industry lobbies or the SEC is like, hey, we cannot do this because that is going to hurt the average investor.
That's a great point, Mark.
And especially if people are trying to, discourage people from actively jumping in and jumping out of things, this is going to be an adverse effect. So this is something that is getting a lot of attention right now from our industry, which is a good thing, I think.
Yes, I would agree with this.
So that's just something to be aware of, is that I just don't think that's going to be a good thing. And I think that what they're trying to do, I get what they're trying to do, but this is not the way to do it because it's going to affect people with a lot less income than the top 5% of households.
It's unfortunate.
So, again, just reiterating what's out in this bill, we could
change.
Sit here another 2 years and not have any changes. So, we'll keep an eye on this and relay any information that we get.
Yeah. And remember, listeners, this could change and most likely will. We just don't know in what way.
Right. All right. Well, we'll leave it there for the week. Anything else before we wrap up?
I would say we have a couple trading days left in this quarter where we stand. Earnings season is right around the corner, about 4 or 5 weeks away, and that's where companies are going to report their third quarter earnings. And I think that's what I would be focused on in the short term.
Yeah. Okay. Well, we'll leave it there for the week. Hope everyone has a great weekend, and we'll see you next week for episode number 117.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.